So, the question is here, when should I do a rate and term refinance? I'm just considering a rate and term refinance. I don't need cash out. That's not the reason I'm motivated. I just see rates are down, and I need some tools to understand how to do this. So stick around, and we'll teach you how to do that. Shouldn't take too long to get through the basic points. But the very first thing you need to understand about when you should do a rate and term refinance is what is a rate and term refinance. And that's just kind of industry slang, really, that we think everybody understands. But really, a rate and term refinance is just basically not a cash out refinance. And essentially, it speaks to your motivation for doing a refinance. You're just refinancing. Typically, it's just to get a better rate. That kind of heavy emphasis on the rate and the rate and term. But typically, it's to get a better rate. You look around and you go, hey, I got my mortgage when rates were 7.5. I see they're at 6.5 now. Should I refinance now? You're refinancing to get a better rate. Now, you don't have to go back out, for example, to a 30-year term, but a lot of times you just reset to a new 30-year term, and so you get a new term as well. Now, there are many options out there where you can kind of match your current term to your whatever's left on your current mortgage to the new mortgage. Those options do exist, but a lot of times you just kind of let it go back out. So that's what a rate and term refinance as opposed to a cash out refinance. And the classic case, and there's a lot of nuance to cash out as well, but the classic case is, let's say I need $40,000 because I want to build a shed, I want to build an outdoor kitchen, or whatever you want to do. You want some cash out on your house, so you refinance your mortgage, you get a big chunk of cash. So that's a cash out. This is not that. What we're asking the question here, because the motivations for that are different, right? The motivations for doing a cash out are different, so it's not so fixated on, am I saving money by doing this? It's more, I need this money, and is this the best way to get that money? Different question. And we can talk about that in a different video. But this is really, rates are, in general, I see rates are better, and maybe I want to do a rate and term refinance, or maybe I just need to lower my monthly payment, and it's not even really tied to rates. So what is a rate and term refinance? It's just not a cash out refinance. You're not doing this to get cash out. Now, just because you do your refinance and you go to escrow and you sign and they write you a check for $600, that doesn't make it a cash out refinance. There are thresholds that you're allowed to take, get a little bit of cash out and still consider it a rate and term refinance. And the reason that matters is pricing's different, underwriting's different, whether they require an appraisal or not may be different. So there's lots of reasons why that distinction matters. But just as a technical point, you can get a little bit of cash out on a rate and term refinance. So what is that? That's what a rate and term refinance is. You're just generally refinancing to take advantage of a better interest rate environment. Now, the second point I want to make here is don't use your grandmother's rule of thumb for your modern mortgage. Now, what does the year have to do with this? Your grandmother's mortgage back in the day versus today's mortgage? Well, the reason I say that is because even now there seems to be this kind of general perception. A lot of people still have this idea that, my rate has to go down by 2 points in order for a refinance to make sense. I'm going to wait till the market goes down by 2 points before I consider refinancing. And that's just because they've heard that that's a good rule of thumb. They don't have any other real way of thinking through this. And that's what this video is about, really, to give you a better tool for that. But the reason I say that, don't use your grandmother's rule of thumb, the old 2-point rule, is because your grandmother's mortgage was $60,000, right? Your grandmother's mortgage was $60,000, and so if you're going to spend a couple of grand to refinance that mortgage, and you're saving, you're only saving 1 point, that's saving $600 a year in interest, right? And it's going to take you a long time to break even. But if you've got a more modern mortgage, let's say you're in a high-cost area like I am, and $500,000, $700,000 mortgages are the norm. Well, now you save a point on a $500,000 mortgage or a $700,000 mortgage, and that's $5,000 a year in interest, or $7,000 a year in interest. And so it doesn't take a lot of time then to break even on those costs, and we'll talk about how to calculate that break even. But don't use your grandmother's rule of thumb. Use a much more objective analysis to kind of compare what's the cost to do this, what's the benefit, how long will it take to break even, and then you can make a much more informed decision. So that's point number 2. Now, point number 3 is the break-even test versus the gut test. And that's kind of me. I have kind of the 2-pronged test when I'm helping my clients evaluate whether or not they should do a rate and term refinance or not. What is the break-even test? And that's really, that is a threshold for me and for the borrower, and that's just for me, is how comfortable I feel recommending that refinance to the client. Is this something I can recommend to the client? Well, if they're going to break even within a couple of years, and I don't know of any plans that they have to divest themselves of the property within a relatively short period, either within that 2 years or shortly after that 2-year period, then I feel comfortable recommending that. But then there's a second level test that only you, the borrower, can answer, and that's kind of the gut test. Because the break-even test tells you objectively, how long will it take me to break even? Do I expect to be in the property this long? And if it's a relatively short period of time, I expect to be in the property this long, then maybe it's worth going ahead and doing that. But then the gut test is kind of for you to say, okay, but is this exciting enough for me to go through the trouble? Because nobody, let's not kid anybody. It's a little bit of effort to go through a rate and term refinance. You gotta go through an appraisal potentially. You gotta sign the application. You gotta produce bank statements, pay stubs, all that kind of stuff, right? And so, is it worthwhile for me to do that? Is it worth my time? Is that monthly benefit or that annual benefit worth my time? Because maybe you look at it and you go, yeah, I can see that this is going to break even within a couple of years, but it's going to save me, $400 a year to do it, and it takes me a couple of years to break even, and the monthly payment changes by, $35 a month. And I just look at that and I think, it's just not worth it, right? That's kind of the gut test. So there's the break-even test and the gut test. And now when we're talking about break-even, even that's not as straightforward as it might sound, because a break-even, there's an expense break-even versus a cash flow break-even. Now, the expense break-even, I think, is kind of the most classic one. You're just in, for most people who are looking to do a rate and term refinance, they're just in it because rates are lower and they want to lower their cost, right? And so in that case, you're going to do the expense break-even test. And the expense break-even basically just says, okay, what's it cost me to do this? And how long before I break even? And the way you determine, the way you determine cost is pretty straightforward, right? You just look at your loan estimate and it tells you there's appraisal fee, there's credit report, there's escrow, there's title, et cetera, et cetera. Underwriting fee, processing, whatever's on there, you add those costs up. Now, when you do that, make sure that you're not including things like reestablishing your impounds for real estate taxes, homeowners insurance. Don't include your prepaid interest, because interest is just interest for borrowing the money. That's not the cost of getting a new loan. That's just interest on either the old loan accruing and on your payoff balance, or the new loan, right? So interest isn't a cost of refinancing. Interest is just a cost of having money borrowed, and you're going to have that cost whether you do this or not. So you don't include interest costs. You don't include any of those: insurance, prepaid interest, real estate tax impounds, all of those things that you need to reset up. But you do include all of those fees that you're paying for the people who provide services or products: credit reports, title, escrow, appraisers, all of that kind of stuff. So you add that up. What's the cost? And then you compare that to the benefit. And that benefit is just simply going to be, new rate minus old rate. Well, let's say the new rate is 6%, and that's really going to be old minus new. And let's say the old rate is 7%, so you're saving 1%. Now, if you're borrowing, like we said earlier, maybe you're borrowing $750,000. Well, you go 1% times $750,000 equals $7,500 a year. So there's $7,500 a year in interest savings in order to refinance. If you refinance and you lower your interest rate by 1%. So you're saving $7,500 a year, and if that costs you $4,000 to do that, it doesn't take you very long before you break even. And I would say for most people, that's going to pass the gut test as well. That's a pretty meaningful amount of money that you're saving. Now, some of you are really sharp and you're thinking, okay, yeah, sure, it saves me 1% on the current balance, but that balance goes down over time, right? When you're paying off a mortgage, that 1% that you saved in interest rate, yes, it benefits you 1% right off the gate, but you're paying a little bit of principal as you go, and so that principal balance is going down like that, right? And so that 1% is now being applied to a lower and lower balance and is of less and less benefit. And that's true, but understand that it's not really relevant in the relevant time frame, right? Because we're talking about break even. How long does it take to break even? And yes, it matters in terms of long-term benefit, and you should kind of think about that and project that out. But really, we're just talking about, most of the time here, 1 to 2 years. And we all know, kind of, if we're dealing with a mortgage, most of the time that principal balance goes down pretty slow. So yes, the benefit will go down marginally over time, but probably over the relevant break-even period, it's not worthwhile to get into the finer calculations to say, well, initially it's going to be $750,000, but then it goes down to $740, and then it goes down to $730. It's not really important to do that. What's important is to kind of figure out that break-even point just using the current balance on your loan or what the balance on the new loan is going to be, and just figuring out what's the old rate, what's the new rate, what's the difference in those rates, and how much is that going to save me. Compare that to the cost, and you'll come up with a number of months it takes you to break even, or a number of years. Maybe it'll be less than a year, maybe it'll be 1.5 years, whatever that number is. And as I said before, for me, generally it's a kind of a 2-year threshold. Now, that doesn't mean I'm not going to talk to you about it, or I'm not going to advise you and say, look, here's the break even. I'm not sure I would do it, but here's what it is. But then it's up to you to kind of do the gut test. That's the expense break even, but there's also a cash flow break even. Some people use this method. I'm not as big a fan of that, although depending on your motivation. If you're going into a rate and term refinance, not so much because you see rates are lower and you just want to take advantage of those lower rates, but you're going to it saying, I'm going to refinance my loan because I just want a lower payment, and I know that I'm going to get a lower monthly payment. So, your old monthly payment versus your new monthly payment, there's a difference in monthly cash flow there. And some people use that as a break even and say, okay, it's going to cost you $3,000, $4,000, but look, your payment went down by $400 a month, and so we divide those numbers out and come up with a break even. And that, I'm not such a big fan of that, and primarily because, your change in monthly payment is, significantly impacted by the term of the old loan versus the term of the new loan. So take, for example, the situation where you got a $500,000 loan 6 years ago, let's say 10 years ago, and now that loan is down to $320,000. But you're still paying the mortgage based upon the interest rate and the $500,000 balance, right? When you get your mortgage, it amortizes that initial loan balance over 30 years, and you pay that same amount every year. So even though your principal has gone way down and you owe a lot less, if you're not refinancing, you're still paying that same monthly payment. Now your principal portion is growing every month, your interest portion is going down, which is good. But if you go in and say, look, I just need better cash flow, I'm going to do I'm going to do a rate and term refinance. I'm not going to take cash out. Well, now you're refinancing out to 30 years, and that is going to have a significant beneficial impact on your monthly payment. But that's not cost savings really, because you may even be taking a higher interest rate to do that and still get a lower monthly payment, and that's fine. There's nothing wrong with doing that. But just understand that that your motivation is different there. Your motivation there is to lower your monthly payment, not necessarily take advantage of a lower interest rate environment. Maybe it is lower interest rate and you're getting a lower payment, that's great. But using the monthly payment as a break-even analysis, really, when you're comparing how long does it take before I recoup these costs that I spent, the monies that I spent on fees, title escrow, appraisal, credit report, etc., and then that I saved an interest rate, I really don't like using that monthly payment break-even because it really doesn't present an accurate picture. That monthly payment you can have a significant improvement in monthly payment and still take a long time to break even because you're just extending that term out for a very long time. So, but anyway, people look at it that way. And again, if your motivation is just to find some relief in terms of your overall monthly payment, you just want to improve your budget, then your break even isn't so much of an issue. It's still something that you can calculate and know, okay, if I do this and I run it out this long and maybe rates are a little bit better, then how long will it take before I do recoup those costs? So choosing an interest rate, let's talk a little bit about that. You've decided that, okay, I'm gonna go ahead and refinance. I've done the break even analysis. I've done the gut check. This makes sense to me. Now, choosing an interest rate. What interest rate do I choose? Now, I just happen to have a loan scenario that I prepared to illustrate this, and it just so happens, that it's a $750,000 loan amount, and it is, just as I illustrated before, it's a 6%. It's at 7% right now. And so when I looked at my pricing today, now this happens to be a VA loan, so these rates don't necessarily correspond to maybe what you're hearing, your average 30-year fixed rate loans out there. This happens to be a VA loan, but it's at 7%. Right now, I could do 6 1/8, and it would cost about $4,000 to do that. And that's all that title, escrow, etc., all those fees. I could do 6 1/8, or I could go up to 6 1/2, and it would cost zero. Now, how does that work? That's basically how, and it doesn't have to be VA, it can be conventional FHA. All loans essentially work this way. Any given day, your lender doesn't just have one rate, right? Your lender has a whole matrix full of rates, and there's typically a kind of a par rate, and that's the rate in which the lender says, this is our going rate for the day, and this is the rate in which you're just going to pay your normal costs. You're going to pay for that title and escrow and appraisal and etc., but we're not going to charge you any extra to get that rate. That's kind of the par rate, and today, on this particular product, it was 6 1/8. Now, so you're going to have about $4,000 worth of cost to do that. Now, but that's not your only choice. Now, some people intuitively, most people understand paying points to get a lower rate. You may say, look, I think I'm going to be in this loan for a long time, and I'm actually willing to pay more upfront one-time costs for a permanent reduction in interest rate because I think over time I'm going to benefit from that. So that's paying points, and maybe I didn't write it on here, but maybe let's say you go to 5 1/2 and you pay $7,000 of points, but you're lowering your interest rate quite a bit, from 6 1/8 to here, and you're paying $7,000, but you're saving quite a bit on that loan, and over time you're going to break even on it if you're in that loan long enough. But the reverse is also true. You can take a rate that's above par. So in this case, we said we're going to pay points to take the rate down. We're going to pay a one-time extra cost to have a permanent reduction in rate because I think I'm going to be in that loan long enough for that lower rate to benefit me. Well, what if you just said instead, look, I don't have a lot of cash right now. I don't really want to spend it on the refinance. Not sure how long I'm going to be in this house, but I like the fact that rates are lower right now. I'd like to take advantage of that without risking a whole lot of paying these fees to do that. Or maybe I think rates are still on the downward trajectory, but I want to lock in at least some benefit right now. And that's something we saw happen quite a bit kind of after the crash in 9-10 when rates started to go down, and over the next decade. We saw rates continue to go down, as many of you know and benefited from over many times over those years. And what happened is people were serially refinancing. And one of the ways that you could do that is you said, look, I know rates are down way below where I am. I'm at 7 right now. Okay, and here's the new par rate. So if I just pay normal fees, I can get the new par rate. But maybe I think, in another 6 months, they may come down even further. So I'm not going to risk paying all these costs up front with maybe the expectation or the hope that rates are going to go even further and I can even take advantage of a lower rate. So I'm going to say, look, if you take 6 1/2, now that's still less than 7, still saves you half a point on your loan, so it's still meaningful. You can save money and you're not paying anything, because what happens when you take a rate above market, then the lender pays you points, what we call a rebate. They pay you points because you're taking a rate above market. And just like you, when your pay points are betting that you're going to be in that loan long enough in order to benefit from paying that extra upfront cost, the lender thinks, here, I'm foregoing, I'm going to pay you, I'm going to pay for your fees because I think I'm going to be in this loan long enough at this 6.5% rate. I'm going to have a rate that's above market, and I'm going to be in this loan. I'm going to, as a lender, going to have this loan on my books long enough to benefit from that. So they're willing to do that as well. They're willing to take that rate and pay that above, or pay your fees so that you'll take a rate that's above market. Okay, so maybe you take that rate instead, and you pay zero closing cost. So it's a low risk refinance in that case. Now you are risking the fact that maybe rates will never get lower. Maybe rates will go up again, and so you'll never have the chance to take that lower rate that you could have gotten today. So it's not like there are no potential negative consequences. But I have seen people do that frequently. And that's also, by the way people advertise, hey, we'll do a free refinance for you. You get a loan with us when you buy your house, and if rates go down, we'll do a free refinance. Well, I can pretty much guarantee you that the appraisers aren't doing the work for free, credit companies aren't doing the work for free, title and escrow aren't doing that work for free. Everybody's getting paid, but they're getting paid because the lender is not going to give you the lowest rate that you could get if you were paying all those fees. They're going to give you a rate that's above market that gives them some rebate to cover those costs. And then they give you a free refinance. And I've done lots of free refinances. They're a great product. But it's good to understand that it's not really free. That why you're getting that free. Now the last thing I want to talk about is the loan amount and cash due at close. Don't sleepwalk that decision about what should your new loan amount be. A lot of times lenders, if you're dealing with a lender or something, a lot of times call centers especially, if you're just dealing with a call center lender, you're not going to get a lot of personal attention where they're going to take you and consult with you and kind of talk to you about, okay, what is this about? What loan amount? What should my new loan amount be? And maybe they'll just ask you, do you want your new loan amount to be equal to your old loan amount? What your current balance is on your loan amount. And you may intuitively think, oh, that sounds like a good idea. Let's do that. Maybe I don't want to roll my closing costs. Do you want to roll your closing costs into the new loan? And maybe you'll say, sure, I want to roll my closing costs into the new loan. But if you don't think about that specifically in terms of what it means for your cash to close, then you've not made an informed decision there. You've just kind of sleptwalk your way through that, and you might be really surprised. So, for example, I've got a mortgage here. I've got a mortgage statement, and of course, I've redacted all the personal information on here so that it's just a basic mortgage statement. But you see here, we've got an outstanding principal of $1,036,000. So here's the things to be aware of. Now, when you refinance a loan, you typically are going to skip a mortgage payment, right? You're going to skip a mortgage payment. And the reason for that is, when let's say that a typical mortgage here's, let's call this March 1st, April 1st, May 1st. Mortgages are by contract typically due on the 1st of the month. Now, you have grace to the 15th, but they're due on the 1st of the month. And you're always paying interest in arrears. So when you make that payment here, let's say you make that April 1st payment, you're paying interest that accrued during the previous month, plus a little bit of principal. And then it starts over again. So what happens when you come here and it's 5/20 and you refinance this loan? So what happens is the new lender says, look, I don't have time to get you refinanced, get you in our system, send you a statement, and have you pay me by May the 1st. So we're going to skip this. We're going to start you June 1st. Right? So right away, you're going to skip a mortgage payment, but that's not free money. Okay? You know intuitively that's not free money because you're going to skip a mortgage payment here. You're going to have to start here. But what happens is, so first of all, the old lender got paid through April the 1st. They got their April the 1st payment. That means their March interest was paid. But this amount of interest wasn't. This is the old lender right here. This is their interest. So that's going to be added onto your payoff balance. So even if you just took the principal balance, that $1,036,000, you're going to pay accrued interest to the old lender up to the day you pay them off. And then the new lender says, look, when I start you June 1st, we're going to skip May. We're still only going to collect a regular mortgage payment. We're only going to collect interest back to May 1st, but we do want this interest, right? That's not free money to you. They do want that interest. And so they're going to collect interest from May the 20th here to the this was 4/20, I should have said, to the beginning of May. And so that's another 10 days of interest. So between them, you're going to pay a full month's worth of interest. Well, look at this old loan, right? Interest portion is like $6,000 on this monthly mortgage payment. Now, the blended rate's going to be a little lower because you're refinancing to a lower rate. So so just understand. So there's $6,000 you may have to bring in. But here's the other thing to notice. Here's an escrow balance, okay? Almost $6,000 in escrow, right? So escrow is what they've been collecting. Notice this borrower, he's paying his escrow, $1,191 tax. That's his real estate taxes and his homeowner's insurance. He's paying that every month as a part of your mortgage payment. And so the lender's collecting these amounts and putting them in the escrow account so that they can pay your taxes and insurance when they come due. Well, you've got to restore that with the new lender, right? You have to put that in an escrow account with the new lender in order to do that. So that's another $6,000, right? That's another $6,000. So if you just kind of sleptwalk through this, you would get to the closing table thinking, okay, my new loan is equal to my old loan, and they ask you to write a check for $12,000. And that might come as a real shock to you if someone doesn't consult you ahead of time and say, now that may be just fine, right? And it could be even higher because, in addition to that, you've got closing costs, right? If you didn't roll in your closing costs, then you've got the $4,000 we talked about earlier. So now we're up to $16,000. And that's a big number, right? That's a big check to write at closing. Now, that may be exactly what you wanted. You may have said, look, I don't want to roll any of my costs into this new loan. I just want to pay those out of pocket. And understand that as long as you can temporarily cash flow that $16,000, then know that there's going to be some offsets to this. Remember, we talked about that you skip a mortgage payment when you refinance. Well, in this case, that mortgage payment that they're usually making is $6,700 a month, right? $6,700 a month is their mortgage payment. So you're going to skip that. So already, as soon as you get to that May 1st date when you would have made that mortgage payment, you're cash flow positive now, that's $6,700. Now the other thing, remember, is you're going to get this money back. This $6,000 that current lender is holding for you in their escrow account, now they owe that back to you. So they're going to pay that back to you as well. So now you're 12 grand to the positive, but this doesn't happen all simultaneously at the closing table. The skipping the mortgage payment happens whenever you would have made that mortgage payment anyway. And that refund of the escrow account happens several weeks later, maybe 2-3 weeks before that lender sends that back to you. So just don't sleepwalk through that. Make sure you think carefully about that. Be prepared for the cash due at closing, and then you'll be well informed to make a great decision about your rate and term refinance.